On the Investopedia Express this week, record highs are back, baby. First half winners and losers. We love it. First half winners and losers, some big stocks making big moves through the first half of the year. Sam Rowe drops in for a few good minutes. We're checking in on investor sentiment, and it's a stock buyback bonanza, plus the Investopedia indicator and what to watch this week. Check it. Wreck it. It's about to get wicked here on the New York Stock Exchange. The Investopedia Express is live. Welcome back and welcome aboard. It's the Investopedia Express live from the New York Stock Exchange, coming to you live every Monday at 10 a.m. And here we are at record highs yet again. Can I get that air horn one more time? That's right. That's right. We'll time that out pretty soon. Stocks at record highs. The S&P 500 and the NASDAQ at record highs closing on Friday and starting that way again this week. It's enthusiasm about a potential tariff deal with China. That's moving markets. Potentially the passage of the big, beautiful tax bill, if that ever happens. A lot of complications there, but momentum is back in the stock market. That is absolutely a real thing. We're going to be looking at what stocks have been moving this year, the big trends that have moved the markets this year. It's been a lot of headline risk, but through it all, stocks back at record highs. The fourth time that has happened this year. Last year, 2024, we had 57 record highs. So we only have a few so far this year. They come in chunks, and when you get record highs, you usually get more record highs. We'll see if that comes to pass this week. So we're going to be checking in on that. And you know what? June has been especially kind to the stock market. Usually it's not one of the best months of the year. It's one of the worst months of the year. You rarely get record highs through the month of June, but we've been getting them. Just a couple as of last week. 4 so far this year, 57 last year. We'll see if that trend continues, because trends in motion tend to stay in motion. Let's look at some of the top performing stocks through the first half of the year. And I'm showing you this just because it's so hard to be a stock picker. I bet you a lot of us didn't have these on our bingo cards this week. Let's run through the list here. Top performers on the Dow Industrials so far this year. IBM, we talked about it last year. That stock's up almost 30. We talked about it last week, I should say. That stock's almost up 35%. JP Morgan Chase, that stock's up 22%. Goldman Sachs, a couple of banks on that list, 21%. Microsoft's on that list as well. Cisco Systems, welcome back to the party. Cisco Systems having a good run so far this year. And the total return for the Dow, about 3%. The losers on the Dow, United Health Group. This has been one of the strongest stocks in the market, not just last year, but for the past several years. That stock down near almost 40%. Apple not having a great year at all, down 19.5%. It's unusual that Apple is having such a weak year, yet the market is back at record highs. You need those big cap stocks, those mega caps, to drag things higher. But the Mag 7 has not been doing all the lifting in this new rally to record highs. Merck down almost 20%. Salesforce 18.5%. Nike just can't do it these days. Stock down 16%, rallying a little bit this morning after earnings last week that were pretty tough, but the company's doing some restructuring. Again, let's look at the S&P 500. Talked about it last week as well. Palantir, top performing stock in the stock market, period this year. Pays to be close to the government. That stock up more than 90%. NRG Energy up 80%. That's been one of the best performers of the past several years. Unusual that it would be performing so well this year, especially given all the talk about those lack of subsidies for solar and other projects. But energy stocks doing well in general. A lot of these powering AI server farms. Seagate Technology up 65%. Howmet Aerospace, you got some defense in there. Aerospace and defense doing well. And then Super Microcomputer, that stock's up 61%, basically a proxy for Bitcoin. Let's look at the losers on the S&P 500 so far this year. And it's Trade Desk. This is, again, one of the best performing stocks of the past 20 years, not having such a great 2025. United Health Group, we talked about that. Stock down 39%. Lulu, not fitting into those this year. And Phase Energy, again, this was a top performer the last couple of years, fading this year as well. Edison International, also down about 34%. The S&P 500 itself up 5%, and again at record highs. Let's scoot over to the NASDAQ to look at some of the best performers in the NASDAQ over the past year. And that we got Trade Desk down, worst performers, I should say. Trade Desk down 42%. Lulu, we talked about. Marvell Technology, they make chips, down 27.5%. Regeneron Pharmaceuticals and Apple not having great years at all. The NASDAQ 100 total return, 7.23% so far this year. The best performers on the NAS. We have that chart. Let it rip. Okay, let's move on. Well, there you go. There's your worst performers again. Let's move on to what a year it's been so far this year. So much headline risk, so much going on in terms of economic policy, tariff policy. We started out with so-called Liberation Day, the stock market falling 19% or so. But we've had a huge recovery, and a lot of that is the enthusiasm behind a potential trade deal. But also, we may get a passage of this tax bill, as mentioned earlier. And money needs a place to go. It's like water. It's got to flow. Usually flows to higher ground. So when the yield on the Treasury sinks below 4.5%, we got pressure on the dollar. Well, people are going to be attracted to stocks, and the AI trade has been pushing things a lot higher. But we've seen a pretty good rotation throughout a bunch of different sectors. It's not just the Mag 7, as I said, doing all the lifting. You have pretty good sector strength when you look at some of the top performing stocks just since February. We got stocks like Dollar General and Dollar Tree powering higher. A lot of that we thought might be a recession trade. It's not. We got stocks in general melting up, a melt up of asset prices in general. Look at crypto, look at the stock market. That's what we call a good old fashioned melt up, and it's about 95 degrees outside. So that makes a ton of sense. Well, let's check in with a very good friend of ours at Investopedia, a guy I've known for a long time. Sam Ro joins the Express with the drop in coming right up. What's up, Sam? Can you skate? Because looks like I can too if you look at that animation. Welcome to the Express, my friend. Good to have you here.
Thanks for having me.
Sam Ro is the genius behind Ticker. If you're not subscribing to Ticker, the Substack, get on it. It has so much common sense, so much clear analysis. Sam has been in this business like I have for a few minutes, and he really breaks things down very well. We're going to put a link to that in the show notes. Sam, we got to talk about the first half of the year. Biggest surprises to you? Name one or two that just shocked you as we sit here pretty much at the halfway mark.
Oh, one or two, huh?
Lay it on me.
I think something. Well, of course, there was Liberation Day, the big tariff announcement, and sort of the pulling back of all of that. I think a lot of people forget about DeepSeek, this huge breakthrough in AI technology and all these things. But I think if there's one thing that I think surprises everybody every quarter or every 6 months, whenever you're paying attention to it, is earnings. Earnings have continued to hold up, and earnings, even amid all this uncertainty, earnings continue to be really resilient and robust. And continues to point up and to the right.
Not only that, it looks like they're going to get better going forward as well. So all that worry, all that concern about profit compression, margin compression, the impact of tariffs, more smoke than fire. But companies, as you know, you and I have been covering this for a minute, they have a clever way of managing their earnings and making sure that they always beat on the bottom line, if not the top line. So that's a big surprise to me as well. They've been stronger than expected. Market's been pretty robust. Individual investors have kind of hung in there. You have some great charts in this week's Substack and this week's ticker talking about the lack of confidence right now in the C-suite. You compare the lack of confidence in the C-suite to what's happening with individual investors and here in the market. Well, that tells you a pretty big story. But look at the CEO outlook. Put this in your newsletter over the weekend. Why so pessimistic?
Yeah, you can't blame them, right? All year we're hearing whipsaw of headlines regarding trade policy and tariffs and all these things that potentially affect the costs of all the inputs and whatever it is you're producing. And furthermore, there's also a threat to the demand for all the stuff that you produce. So of course, it makes sense that CEOs would be pretty unhappy about all this stuff because they also read various surveys too. They read their customer surveys. They talk to their clients and all that, and everyone feels uncertain, and rightfully so, because we actually don't have a whole lot of clarity as to what things like trade policy and frankly tax policy and a lot of other policies look like. So yeah, it's fascinating that how much that sentiment has deteriorated.
Also, when you look at the CapEx spend or the plans for CapEx spend, which really, usually drives spend usually drives some growth usually drives higher profitability if it's done right. That looked like it was trailing off as well. But if you're a CEO or a CFO and you're looking at potential 15, 20, 25% tariffs on steel, aluminum, a lot of other goods, well, you're not going to make big investments in CapEx. So we haven't seen a lot of that. Unusually, you'd see a drop in CapEx, but a rise in profits and a rise in stock prices, right?
Yeah, it's fascinating how much the sentiment toward things like CapEx spending is very poor, but the hard data around CapEx, stuff like CapEx orders, machinery orders, equipment orders, the stuff that's actually getting booked has actually held up pretty well. And I think that kind of helps to explain why earnings have held up and the outlook for earnings are okay, and why the stock market, frankly, is doing pretty well. You only wonder what would happen or how much higher the stock market would be if CEOs were just a little less pessimistic. But all things considered, this pessimism goes hand in hand with what's been pretty, a little bit of resilience in the hard data.
And that's what you hear when you hear from Fed Chair Powell. It's like, hey, we have not seen the impact yet. We know it might be coming, but because there's been no clarity on policy and no actual policy, it's hard to put numbers around the threat of tariffs except sentiment. And sentiment has been poor, but it's getting better. I want to look at your one chart on CFOs as well. You want your CFOs to be a little paranoid. You want your the guys, men and women who are managing the money, to be paranoid. I know our CFO is pretty tough about that, pretty pessimistic. But they're pessimistic too. Yet profits are okay, right? Spending seems to be holding up in some areas, especially when you look at the super high end. But even on the low end, it's held up all right. A lot of that has to do, and you put it in your great newsletter over the weekend, with gas prices. When gas prices are low, we spend. But when you look at CFOs in the corner office crunching the numbers, they're pretty pessimistic right now, despite the fact that we're okay.
Yeah, the paranoia is in many ways probably something that's very bullish, right? I think it's reasonable to expect some of this uncertainty regarding policy to scale back, for better or worse, right? Maybe we get a less than favorable new tax policy, or maybe tariffs are a little bit higher than expected. But once you get that clarity, then companies can start moving forward with their decisions. So, maybe the uncertainty that we have is prudent by these financial officers and these executives. But that also leaves room for some upside. Because, like you're saying, it's good for executives to be conservative and paranoid about things. That means they're not taking, excessive risk. But yeah, again, we have to imagine a scenario where, well, what if those animal spirits start to come back to those C-suites? Then how much further higher can earnings and activity go?
Yeah, great point. Let's flip things over to the individual investor sentiment side of things. We run a survey of our newsletter readers every 2 months, just wrapped it up last week, even after conflict in the East, after all the tariff concerns. Every 2 months, we're checking in on them. Are you bullish? Are you bearish? What are you afraid of? What are you buying? What are you selling? And guess what? They're pretty cautiously optimistic. Individual investors, Sam, have hung in there, bought the dips when they thought they could. Not all of them, but some of them, but really have done exactly what Jack Bogle told us to do, which is stand there and do nothing and wait for this to blow over. So you see about 42% cautiously optimistic, another 15 or so percent optimistic. That's pretty high when you compare that to, say, the global fund manager surveys out there. They're super paranoid, but they're protecting other people's money. Individual investors like us are saying, hey, it's headline risk. I can't do much about it. I'm going to keep buying. Let's look at the next chart, because individual investors and CFOs and CEOs, they're all worried about the same thing. Last week it was the war in the Middle East, but it could also be, might as well replace that with tariffs, because that's been the number one concern. U.S. relations with China, that's been on their mind a lot as well. These are the things that individual investors are most concerned about. Foreign policy related things, not much we can do about those, but watch the headlines and hope it blows over. But when you saw what happened with oil prices, those snap lower pretty much right away as that conflict in the Middle East was quelled. So we're all kind of worried about the same thing. The question is, what are we doing about it? What are we doing with our money? So when we ask our readers, what are you actually doing with your money, and where are you putting it? A lot of them are still buying the same individual stocks. When you look at the most popular stocks in all of our portfolios, Sam, they look exactly the same. We look like the top of the S&P 500 or the NASDAQ 100. We look like a big index fund, and we operate like one. Let's look at that word bubble if we have, of all the tickers we have. This looks like everybody's portfolio. We keep buying the same stocks day in, day out. There it is, Apple, NVIDIA, right? These are the three stocks that our readers are most invested in. That looks like everybody else out there. So when you have this relentless bid, Sam, people buying the same stocks, even in Apple that's down 20%, that just tells you that we're creatures of habit, and that, I don't know, the market might just have to keep this relentless bid on and keep pushing higher if we keep doing the same thing.
Yeah, and I was thumbing through your survey results, and I think it's a good mix of um, how investors feel about the state of the markets, and it's probably to the credit of you guys at Investopedia. You guys do a really great job of educating investors, right? Something I like to sometimes joke. I don't joke this. I mean this really seriously, but I consider myself an optimist long term and a cautious optimist short term, right? You can have both of those emotions and feelings, but maybe it differs based off of your time horizon. As a long-term investor, with long-term financial goals and a strategic investment plan, you stay long, certain positions or index funds or whatever according to your investment plan. But it's okay to be a little cautious short term, because that's what the history tells us. In the long trajectory of the market going up, there's a lot of volatility in the short term. So it makes sense that people would be cautious, but also very much invested into the stock market.
That's right. We may be cautious, we may be scared, but we often don't change what we do. And guess what? Every 2 weeks, if we're contributing to the 401k, the IRA, or the Roth IRA, we pretty much do the same thing. It's like we don't change our banks that often. We don't change our credit cards that often. We don't change our allocations that often. And most of the time, that pays off. Last chart here. Let's look at the stocks that we asked our readers, if you could buy and hold today for the next 10 years, which would you choose? And that list looks very similar, but you see a big Berkshire Hathaway name up there, even without the Warren Buffett premium. But NVIDIA is everybody's favorite stock, and it's kind of become almost like a value play in some ways, because every time that stock dips 10, 15%, investors rush in and buy it up, and it's the biggest company in the stock market, and it's only getting bigger. This list surprise you at all?
Most of it doesn't surprise me. AI is the biggest business story that we've seen maybe in decades, and it's gotten real traction. There are companies that aren't in tech that are adopting this technology to improve productivity and the efficiencies in their operations. And I think that's something that we're going to be listening for in the coming earnings seasons, as companies actually tell us, the tangible benefits, or maybe, if it's disappointing, that's going to be a story in itself. But yeah, I'm not surprised to see a lot of the big tech and the AI infrastructure players in there. I am surprised about Berkshire Hathaway.
Me too. Me too.
Especially with Warren Buffett's retirement announcement. Not that it was surprising; it was due to come. But the stock price reaction in the last 2 months from the Berkshire Hathaway shareholders doesn't reflect a whole lot of confidence. Then again, maybe this is the value investors seeing how much the price has come down in the last 2 months, and they're thinking, hey, maybe this is a great long-term investment.
Absolutely. That sounds to me like maybe one of our older readers that may be sitting on a big position in Berkshire A's or Berkshire B's doesn't want to let go. And also, the portfolio is really strong. But you and I were together in Omaha when that news dropped, and it wasn't shocking, but it did reverberate, you should say, through.
No one at that meeting is selling.
Right. Absolutely. They're going back and buying more Justin boots and Fruit of the Loom underwear. Let's go out on this, Sam. Cryptocurrencies. Good question from Sherry, 99999. That is not on our list of stocks that you would buy and hold for the next 10 years. But when we asked our readers, you had an extra $10,000, where would you put it right now? Well, the number one choice is individual equities, right? The next choice is ETFs. Cryptocurrencies is down the list. But when we asked them, what asset class, Sam, do you think will perform best under the Trump administration? Individual stocks, number one. Number two, cryptocurrencies, because they know this administration is behind the crypto movement in a big way. They all have their own coins. They're creating their own exchanges. They're allowing stable coins into the mix, into our banking system. You can now securitize your loan for a home through Fannie and Freddie through Bitcoin. So they think cryptocurrencies are going to do well. And if they've made that bet so far in the first few months of this administration, they've been right. All right, let's go out on this, Sam. We are journalists, but we're also market observers, and we can't help but make predictions. I would love your prediction, hot take for the next 6 months of the year. What are we not thinking about that we should be thinking about, or what is out of our minds that's on your mind that you think might come to pass over the next 6 months of the year?
Yeah, I mean, I'm not going to say this is a baseline scenario, and I don't like to, commit too much to predictions, but I think that there is a very much a real risk that the U.S. economy goes into recession at some point this year. It might already be there. It might happen sometime during the summer. It might happen during the fall. I don't know if it's going to be particularly deep, but with a lot of the economic data, still positive, but a lot of it has been cooling. And then, we were just talking about all this uncertainty out there. I think it's possible that we hear about the economy going into recession, maybe a short and shallow one. But I'll add this sort of curveball to it. I think it's possible that happens, and I also think that it's possible that the stock market continues to set new highs. And then we're going to have a lot of think pieces at the end of the year talking about why the stock market and the economy are not the same thing.
Yeah, I can't wait. I love writing that piece. That's my favorite piece because they're not the same. Sometimes they show up at the same family barbecue and they walk a little hand in hand, but most of the time they're doing their own thing. And investors right now, they are running with the bull. Sam Ro, the genius behind Ticker, good friend of mine, good friend of Investopedia. We're going to link to your terrific Substack in the show notes. Thanks so much for joining the Express live here from the New York Stock Exchange, my friend. Appreciate you.
Thanks for having me.
All right, let's rock a little money in motion here. And who wants to be a millionaire? Well, a lot of people, and a lot of people became millionaires over the last couple of years. I was looking at a study from UBS. The U.S. added 1,000 new millionaires per day in 2024. That's the fastest growth globally, according to U.S. China was next, about 380 new millionaires every single day. Now, individuals with $1 to $5 million in assets, that has quadrupled since 2000. If you are not invested in the stock market, in the capital markets, or if you don't own assets, you can't join the class. You've got to be invested. And that just shows you 52 million people, 52 million millionaires right now every day. Globally, real estate has been the biggest driver of wealth. Outside the U.S., it's real estate that really drives asset prices and wealth and household wealth. But here in the United States, it's real estate plus investments. So when you look at Australia, 53% of the wealth held there held in real estate. In the UK, 42% held in real estate. In the United States, 37% held in securities, stocks, 30% in real estate. So you need that balance here in the US. And we know that as the rich get richer, the lower income folks are just not keeping up. We got a K-shaped economy where the wealthier are getting wealthier, the poor are continuing to struggle. That's why you have to be invested. The wealth of the top earners grew 147% from 1983 to 2016. Middle earners only grew 13%. You're in the lowest income bracket there, you actually lost income about 8%. So when you look at 401k balances, where a lot of us have our money, 544,000 Americans have a 401k balance above $1 million as of the third quarter of 2024. So we know that being invested helps a lot. And if you stayed invested through all the ups and downs, through all the topsy-turvy headlines that have gone on, you have done very, very well. All right, let's move on to buybacks. Stock buybacks, big driver of profit growth here for U.S. companies. When we look at which companies have been buying back their stock, it's been pretty incredible. According to S&P Dow Jones Global Indices, buybacks set a quarterly record in the first quarter, up 20.6%, $293 billion worth of stock buybacks. The biggest companies making the biggest stock buybacks, you got them right there. Apple, $26 billion in stock buybacks in the first quarter of 2025. Meta's right behind there, 17.6 billion. Nvidia, big buyer of its own stock. Alphabet, of course, JP Morgan Chase, and Goldman Sachs. You got a couple banks doing that. Now, why do companies buy back their shares? Well, sometimes they do it because there's no better use of their money. They often do it because they think their stock is undervalued. But a lot of times you see companies doing it for tax reasons. Why are they buying back their stock instead of investing it in capital expenditures, making an acquisition? Sometimes it's more tax advantageous to buy back your own stock, take shares off the market. When your profits rise, your profitability, your PE ratio looks a little bit better. Stock buybacks are fading a little bit in this quarter, according to S&P. When you look at that first quarter of 2025, companies were gobbling up their own stock, and probably a pretty good move. A lot of those stocks fell a lot in the first quarter of the year, so they made a pretty good trade, as we would say. And who's a big fan of stock buybacks? Warren Buffett himself. He loves stock buybacks, and he says, hey, it's our money, it's our stock, and sometimes it's the best use of it. That's why you see companies buying back stock. It is a trend that will never end, but you know that when companies are buying it back, sometimes they think their stock could go higher and it's undervalued. So keep a close eye on that. We will watch it for you as well. Speaking of what's ahead this week, we got a shortened trading week this week because we have Independence Day on Friday. So let's look at some of the big market moving news coming our way this week. Today, here we have Monday. Fed Speaker Austin Goolsbee will be on the speaking circuit today this week. Earnings from Progress Software. Tomorrow, July 1st, you get a manufacturing report, the ISM Manufacturing Survey for the month of June. Construction spending for the month of May. Job openings, the JOLTS report for May. Job openings and labor turnover survey. We'll keep a close eye on that. Constellation Brands will report quarterly results tomorrow. Moving into Wednesday, ADP private payrolls. This is the big jobs week, shortened week. Again, Friday, markets are closed for Independence Day, so we're going to get the June jobs report, the payrolls report, out on Thursday. All the jobs data coming our way this week. So we'll keep an eye on all of those to see if they move the market, and we'll see if job growth continues and that unemployment rate sticks at around 4.2%. Fed likes it right between 3.5% and 4.5%, 4.5%. We got an unemployment rate of 4.2%. The labor force participation rate is something we'll keep a close eye on as well. Let's look at the Investopedia indicator of the week this week. This is something we like to look at every week. What one indicator out there is the one that's going to potentially move markets. And when we're looking at that, we're looking at the simple moving average. When you have a market melt up like the one we have right now, we want to look at the moving averages, the simple moving average. That's the average of a selected range of prices, usually the closing prices by the number of periods in that range. I like to look at the 50-day, the short-term simple moving average, and also the 200-day. What's the short-term trend telling us? What's the long-term trend telling us? That tells us, if we look at it right now, the simple moving average of the 50-day, that's pretty strong right now. We've got a lot of stocks with momentum up and to the right. You don't want that with just a few stocks. You want the entire index to being moving higher. You want the simple moving average of the index to moving higher. And guess what? It is right now. We have strong breadth across the stock market. As I said, we've got averages moving higher. Let's see if that continues. You want momentum across the board, like a good basketball team. You want scoring from all your 10 players, and you want your averages to reflect that when they are trading higher. Let's look at a couple of comments coming through from the good folks out there listening and watching the Investopedia Express. Shameless on Wall Street. I hope Caleb keeps doing these every day. It's like the Caleb Silver Show, live from Wall Street. Thank you, Shameless on Wall Street. Very kind of you. I don't know if I could sustain this every single day, and I don't know if you want to look at me every day, but I appreciate you. Jack Zybrands, any comments on the trend towards energy independence or lack thereof globally? Well, we are still in a globalized world, so this conflict in the Middle East and the wars in the Middle East that sort of had a ceasefire last week, that just shows you how dependent we are. We know that Iran and China are we know that China and Europe are big customers of Iranian oil, so we are still very dependent on one another. The United States has tried to become a little bit more energy independent over the last couple of decades. Not quite there yet, but we'll see if we get a little bit further with the drill baby drill mantra. RD is asking, is the S&P 500 a good ETF to invest in, or is it better to invest in European ETFs? How about yes and? RD, we're in this strange period of time, maybe coming to an end soon, where stocks outside the U.S. have outperformed, and markets outside the U.S. have outperformed the U.S. markets. And a lot of that was because of the tariff threats. And now we see the S&P 500 at record highs. But the European stock markets have been pretty strong, especially in areas like Poland, one of the strongest stock markets in the world. So I'd say a little U.S. and a little overseas, and Europe's not a bad place for that either. Make sure you have a diversified portfolio, not just in the stocks you own, but around the world. And the guy AA asks, when's the stock market going to drop? I don't know. Could be later today. Could be this week. We can't predict that. But generally speaking, stock market is up 73% of the time and down around 27% of the time. So if you just invest and keep investing and keep buying and dollar cost average, you're going to take advantage of those dips when the stock market does fall, because it does happen. And hey, we could have a 10% correction just like that. We had one just a couple months ago. It was cute, 19% actually. But generally speaking, stocks generally are higher 73, 75% of the time. Dizon says he's a fan of Caleb since EYL, one of the most underrated sources of info. Keep it coming. Thank you very much, Dizon. We love EYL, Earn Your Leisure. Check those guys out. Monday nights, Market Mondays podcast, always solid with Troy, Rashad, and Ian. And they have InvestFest coming up at the end of the summer in August in Atlanta. Check that out as well. We are here every Monday live from the New York Stock Exchange, 10 a.m. Monday mornings, and then on demand on your podcast platforms. We're going to link to all the reports we cited in this week's show. We will link to our friend Sam Rowe's terrific Substack ticker. And of course, check out Investopedia.com always and all the time. The news is free. The information is free. It'll make you a smarter investor. That's what we want to be, smarter, educated investors, so we can make the right decisions. Thanks so much for joining me. We'll talk again a little further on down the line.